As someone who pursues both dividend growth investing and income investing, the biggest thing I fear is a sizable dividend cut to one of my holdings. We all know 2022 and now 2023 have been difficult times in the market as no sector hasn't been negatively impacted by this bear market. According to Yardeni Research, we've been in a bear market now for 382 days, and since the average bear market lasts approximately 289 days, it's looking like we're going through a much longer than average bear market. And in my opinion, the key to this bear market ending is going to largely depend on inflation slowing down. Fortunately, we did receive some good news recently that inflation does appear to be slowing down. As both a dividend growth investor and an income investor, I say this all the time on my channel that to investors like us, share prices are not the most important thing in investing. Now, obviously, you don't want to invest in a stock or a fund that's taking a nosedive because it could be an indicator that the company is in a dire situation. But in general, more importantly than share price fluctuations is the ability of a stock or a fund to be able to maintain their dividend payments. If share prices go down on high quality stocks, then it's actually good news for us because if we're buying more shares or reinvesting dividends, it means we can pick up more shares or fractional shares at a discount. But the reality is it's much worse to have a stock's dividend get reduced for investors like us. It's especially true if you happen to be living off dividends because your dividends are part of your livelihood. If you have a large portion of your portfolio invested in a company that has a sizable dividend cut, it can mean having to reduce living expenses or sometimes even worse than that. People who watch my channel know that my investments can sometimes be riskier than the typical dividend stock like Johnson & Johnson. Many of my holdings like M-REITs, BDCs, equity REITs, and closed-end funds can feel a lot more pressure when volatility and interest rates are high. So I imagine people are wondering just how well my investments have been doing in regards to being able to pay high dividends. For the sake of transparency, in today's video, I'm going to talk about every single one of my stocks that have gone through a dividend cut. I'm also going to discuss what I liked about these companies that made me an investor in the first place and what my plans are for holding these companies going forward. So with that being said, let's go ahead and get started. The first stock that I own that's gotten a dividend cut in the last year was Sachem Capital, ticker SACH. They're a Connecticut-based real estate finance company that specializes in originating, servicing, and managing a portfolio of first mortgage loans. Sachem offers short-term, secured, non-banking loans, which are sometimes referred to as hard money loans to real estate investors. The company lends money in order to fund the acquisition, renovation, rehabilitation, development, or improvement of residential or commercial properties. Their mission is to create value for their clients and shareholders with tailored solutions across different real estate assets. Sachem Capital is structured as a mortgage real estate investment trust, which requires them to pay out 90% of their earnings to shareholders in the form of dividends. They're actually one of the smallest companies in this sector, currently ranked as the 34th largest M-REIT according to finance charts. Sachem has $562 million in assets as of last September. Their average loan size is less than $1 million, and 83% of their loans have terms of less than 1 year. So you can see how they specialize in smaller, shorter-term loans. Their stock's basically a penny stock, going for about $3.80 a share, and it's the only stock that I own that currently trades for less than $7. Since 2020, SACH had been paying a quarterly dividend of 12 cents up until July of 2022, when Sachem announced that they would be increasing it by 2 cents to now 14 cents per share. That wasn't 12 cents plus a 2-cent special dividend or anything like that. This was the base dividend that was announced as being 14 cents per share. Strangely though, just 3 months later in October, the company announced that despite the increase that they would be decreasing it back down to 13 cents per share. So technically considered a dividend cut for this holding, at least they're still paying more than they did a year ago. They've gone through 3 consecutive quarters up to this point without changing their dividend amount of 13 cents. So why did I buy Sachem Capital in the first place? It's a pretty risky holding considering how small they are, not to mention it's an M-REIT, which is already a risky type of investment. There's a couple reasons that made Sachem Capital different from other types of mortgage REITs to me. What I like is that Sachem Capital issues their own loans as opposed to investing in already existing loans or mortgage-backed securities. These kinds of M-REITs typically perform better because companies like AG&C don't issue their own loans, but they instead invest in pools of security structured by banks and other financial institutions. Sachem is also a company that's continued to grow their assets considerably over time. A lot of big-name players in the M-REIT sector have been struggling a lot with plummeting book values, but Sachem's been a lot more stable. You would think this company would be struggling right now given how high interest rates are in the real estate market in general, but just 2 weeks ago the company released their earnings statement and they performed better than expected. But there's still no doubt that this is a riskier type of holding. If interest rates keep climbing or remain high for a long period of time, then Sachem will feel more pressure. Their stock is currently one of my smallest holdings, and I don't mind being an investor in Sachem. My plan is to keep staying invested in this company. Another one of my stocks that's seen a dividend cut is Ready Capital, ticker RC. They're a real estate finance company in the United States who originate, acquire, finance, and serve small to medium-sized balanced commercial loans. They also perform these services for Small Business Administration or SBA loans, residential mortgage loans, construction loans, and they hold mortgage-backed securities. Just like Sachem Capital, Ready Capital is structured as a mortgage REIT who are required to pay out most of their income in the form of dividends to their shareholders. Ready Capital is a much larger MREIT than Sachem, as they're currently the 13th largest in the sector. I first got into this stock a little over a year ago, and back then, Ready Capital was paying 42 cents per share in dividends each quarter. But in December, the company announced that they would be cutting their dividend amount from 42 cents to 40 cents per share. Since then, the company's continued to pay this amount, and there haven't been any additional cuts. Considering it's only a cut of 2 cents, it's not great, but it's still not earth-shattering either. Again, because it's an MREIT, I do consider this type of holding to be riskier like Sachem. Now, what makes Ready Capital different than other MREITs in my opinion? Just like Sachem, RC follows a differentiated strategy than others in this sector. For one thing, just like Rhythm Capital, RC's been diversifying their business by acquiring and merging with other businesses over the years. They've been doing this to make themselves more stable during all economic conditions. But it's my opinion that Ready Capital hasn't done as well of a job in terms of diversifying as Rhythm Capital has. Because Ready's been acquiring more lending and mortgage companies, whereas Rhythm's been expanding into different areas of real estate like property management and leasing single-family homes. Actually, Ready Capital was just in the news recently because they acquired Broadmark Realty, which has been a struggling MREIT for years. I made a video last March where I went into more detail about it, and I honestly have mixed feelings about them acquiring this company, but I'm in the same situation as Sachem Capital, where Ready Capital is such a smaller holding of mine that I'm planning on just riding things out and seeing how it goes. They're a much bigger company than Sachem, so that does give them some additional strength. So far this year, RC stock has been struggling, as it seems like I'm not the only one who's questioning their merger with Broadmark. And these are the only two individual stocks in my portfolio that have gone through a dividend cut up to this point. I don't count the covered call ETFs in my portfolio because those pay a variable dividend. No matter the market conditions, you can see the dividends increase one month, go back down the next, and then go back up the following month. But those are the only individual companies that have seen a dividend cut since this bear market started. Fortunately, none of my closed-end funds have seen a dividend cut either, although my PIMCO funds have been under some more pressure this year. Ultimately, I think what makes my high-yielding strategy a little safer is the fact that I don't reach for the highest possible dividend yields that I can find, which is a very common mistake that income investors make early on. To give an example, one closed-end fund that's popular among income investors is the Cornerstone Strategic Value Fund. This monthly paying investment currently yields close to 19%, which is crazy. But this is one of the highest yielding publicly traded investments in the US and yields significantly higher than other closed-end funds. So that should be a big red flag to investors, and we can see over the last 3 years, CLM has seen multiple dividend cuts. To reiterate what I mentioned last week, if you invest in higher yielding investments that yield around average for that kind of stock, then you're generally going to be safer. Definitely not risk-free, but you will be in a better position. Obviously, I have no way of knowing for certain if any other of my holdings are going to go through a dividend cut. The only thing that I can do is keep my eye out for news regarding my holdings and address the issues that I see. Minor dividend cuts are not the end of the world, like maybe a penny or two. It's the much larger cuts that I fear the most, but as of right now, it doesn't appear that any of my holdings are in any dire situation. Hopefully share prices will keep recovering like they have been over the last couple weeks. But with that being said, thank you all so much for watching today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.